The Reserve Bank has put borrowers on notice, sounding the alarm on the looming deadline for $500 billion worth of interest-only loans. In its financial stability review, the RBA says $120 billion of interest-only loans will expire each year until 2021. And that means borrowers will be facing a 30 to 40% jump when they are forced to move to paying down the principal. Although the RBA maintains most borrowers can handle the hike, it expects a minority will struggle and could be forced into fire sales. UBS chief economist George Tharenou was predicting problems in the housing market before the release of that financial stability review. He thinks after the Royal Commission, the banks are going to have to lift their lending standards, making it much harder for people to get credit. And with less credit, house prices are going to fall. I spoke to George Tharenou earlier today. George Tharenou, thank you for joining the business.
Thank you.
Now, you've been sounding the alarm on house prices and the possibility of a large correction in house prices for a while.
Yeah.
What is actually going to be the catalyst this time? What's different?
The key issue facing the Australian housing market is that with the pressure of a Royal Commission and banks facing greater regulatory scrutiny, we think they will tighten their lending standards, and you're likely to see a persistent fall in home lending and credit availability over the next few years.
But why does that hurt house prices? Surely it shouldn't just be determined by how much money somebody can borrow.
Well, historically, the supply of credit, rather than the supply and demand of people in home building, has been the key determinant of house prices. It's really about the marginal flow of credit availability that determines house prices for everybody. You can think about the simple example in Western Sydney where people are saving to buy a home, and they can put together a deposit of around, say, $100,000. And a typical home in Western Sydney currently is around $750,000. So they're needing to borrow to fund that purchase a significant amount, around $650,000. And for a lot of people on a family income of around $100,000 to $125,000, they're having to borrow a significant amount of money, around 5 times their income. Now, that's been pretty normal in this cycle, but historically it's not. Traditionally, banks would lend something like 3 to 4 times as a ratio of income. Now, we think what's going to happen under this credit tightening scenario is that the availability of credit will probably fall something like 20 to 30%.
So if we're seeing credit crunched in the effect that the banks are going to be lending to those same people 20 to 30% less money, does that mean do you think they'll be bidding 20 to 30% less for those same houses?
There would be a significant step down in prices, but not every single person's borrowing the absolute maximum. What it really does is reduce the volume of activity, and also with a lag, people who are under stress looking to sell will have to just meet the market. And so I think you'll see this persistent grind lower in house prices over the next couple of years.
How quickly do you think we'll see a real impact on house prices?
I think it is going to take some time. If you think about that, the change in lending standards is really only happening right now. It will take a number of months before people realise that their maximum borrowing capacity has reduced. When they go to the bank to make an assessment, they're going to get a lot less than they thought previously. Then they will change their decisions around, well, how much can I actually afford to borrow? What type of home will I want to actually be able to get? And then over time, you see a reduction in activity and prices in the housing market. I would think this process is going to play out over the next 12 months or even perhaps 2 years. And it wouldn't be surprising to me to see a credit tightening scenario drag down house prices persistently. Because what normally happens is the RBA, if there's an environment of weak house prices and a softer economy in the back of that, would just cut the cash rate. They did that in 2016, and they re-accelerated housing quite strongly. We saw a return to double-digit house prices. They're not really pushing that angle right now. The RBA seems quite comfortable with interest rates where they are, and they want to reduce risk in the housing market. So my view is things probably have to get worse before they get better.
The Reserve Bank, out with its financial stability review today, they've pointed to interest-only loans and the deadline or expiration dates on these loans over the next 4 years as putting about $500 billion worth of interest-only loans up for renegotiation, if you will. And they've said they are concerned about people not being able to afford that rollover to principal and interest. How big a problem is that for Australia?
I think the issue for the interest-only expiry is that the flow of new lending that led to the boom in house prices was very easy. there was around 40% of loans that were written on interest-only terms, and also the income assessments and the living expenses assessments were quite lax. Going forward, I don't think that policy tightening will reverse. And so the issue really is not about the ability of the expiring stock of interest-only loans, whether they can repay them, whether they will default. I think it's more about the availability of credit for the new marginal borrower.
So the boom is over.
That's right. I called the top in housing a year ago because of the macroprudential tightening, and it's playing out. I think we're just at the starting point of what I've called the third phase of macroprudential tightening around regulation and lending standards, and that's the direction policymakers want to take. Longer term, it actually is a positive. It is clearly reducing risk in the housing market, but the problem we face is the adjustment to go from A to B. To go from a period of easy lending standards to tight lending standards runs the risk of unintended consequences, and that could be the so-called wealth effect, where the drop-off in house prices causes consumers to drop their consumption, and that feeds back to the labour market. This is not really around banks and a blowout in bad debts. That's a really Armageddon scenario which seems unlikely, but it is likely to have a broad macro impact that's quite weak for the next 12 months or so.
George Tharenou, thank you for joining the business.
Thank you.